you know, the numbers are just all over the place. That services number, big miss, going back to August 2017 levels, just as there was optimism that maybe the data was bottoming.
Yeah, but look, it's still a solid number. It looks as though we still have this kind of first quarter aberration with the seasonally adjusted data. It's been weak for 6 of the past 9 years. And I think we're going to start to see better growth in the spring, as Chauncey Gardner once said.
Better growth in the spring means higher stocks and higher bond yields?
Yes, it does. Yeah, as a matter of fact, the yield curve, which everybody was stressing about, may not invert as the bond yield maybe goes closer back to 3%, because the economy is doing better. Not that inflation is coming back, but look, I think we are going to get a China deal, and I think we're going to get what I call a peace dividend. The global economy has been held back by the uncertainty of the tensions between China and the U.S. Put that behind us, and I think the global economy may also start to show some signs of improving.
How can you say that without knowing how Brexit is going to turn out, or without knowing, even if we do get a trade deal, what happens to the tariffs?
Well, as a forecaster, I can say anything I want. The question is whether I'll be right or not.
Fair.
But look, I don't really have a clue on Brexit. They keep stretching it out. They clearly don't want a hard Brexit. But I don't think even if they had a hard Brexit, it would really be unsettling for the U.S. economy. I think the U.S. economy is still doing awfully well and can to some extent decouple from the rest of the world, as we have been.
Jill, where are you thinking? I mean, after looking at services this morning, I guess nothing does move in a straight line, but how much can this give us in the way of upside?
Right. I think it's an important point that a lot of the data that's been coming in recently has been mixed. And first quarter is usually a seasonally weak quarter for earnings season coming up next week. Consensus is obviously expecting negative earnings growth for the quarter. So I think overall, with a lot of the signals that we're looking at, whether it be the Fed, whether it be the economic data, some of it's been coming in mixed. You're seeing green shoots globally a little bit, starting to see earnings revisions bottom out, both in the U.S. and globally. So overall, we're still looking for upside to the market this year. We have a 2,900 target on the S&P 500 for year end, but risk reward a little more mixed from here. That's obviously not strong upside. And I think the opportunities from here, you really want to focus on sector or style or theme specific opportunities rather than just buying the market wholesale.
One thing you've been really skeptical of, Ed, is the idea of an earnings recession. Yes. Although I assume you're looking, I mean, your Q1's going to be negative, yeah?
Well, that's what the analyst consensus is right now. And the latest numbers, we watch it every single week. It changes. And right now, the analysts are looking for a decline of 1.8%. But as I get closer to the actual earnings season, once you get in the earnings season, you actually see a hook back up. Right. So we're just really just a tad below zero. I could see this thing still showing a positive number. And then for the second quarter, they're still looking for a positive. Look, everybody knows that we're going to have weak numbers in the first half. I completely agree with Jill on that. But the market looks forward, and I think what the market's looking at already is the second half. By the fourth quarter, we should see double-digit comparisons for earnings.
One of the bullet points, Jill, in the in your full screen there that outlined the Bank of America case was 58% of the signposts for bear market indicators are checked. Bear market signposts are triggered. Excuse me. What does that mean? It sounds scary.
Right. So we've been trying to figure out, when will this bull market end? It's the question on everyone's minds. And we've been tracking a list of signals that if you go back to all the prior market peaks going back to the 1960s, we tried to figure out what usually happened ahead of those market peaks. The Fed usually hiked a certain number of times. The VIX usually rose. The markets were usually up by a certain percent. Certain styles or attributes outperformed. Investor optimism typically transitions into euphoria. So we assembled this list of signals, and today we're at about 58% of them that are flashing red, which might sound bad, but actually when we looked back at all the prior bear markets that began, you had 80 to 100% of those signals ticked off before the market peaked. So we're not there yet, so we think there's still room for upside to equities, but that's something we're watching closely. And that investor optimism turning into euphoria is one of the signals that hasn't yet been ticked off. Investor cash levels are still pretty high. Sell side recommendations to how much an investor should put into equities have been ticking up, but are still below levels that would suggest you should sell. So those are some signals that we're watching.
Not quite there.
And normally I wouldn't ask, but the president did today reiterate his threat to close the border.
Right.
How much of this should matter? Is this within the realm of reasonable expectations?
Yeah, I may be a little too glib about Brexit, but I think closing the border with Mexico could really be very chaotic for the U.S. economy. There's a lot of components and parts and trade that occurs with Mexico.
But maybe the calculus is we have the cushion to do it, right?
Well, I wouldn't want to stress test that concept. I think we are very much of an integrated economy with Mexico, with a lot of dependence on parts and goods that come from Mexico. So I think that would be pushing it. And corporations have reached out to the president and said, don't go there. It's just way, way too chaotic for the U.S. economy.
So I always think of you as the man who invented the bond vigilantes. You coined the term, right? And they've been in hiding. And what's interesting is that our deficit has been rising at a time of expansion. Both political parties right now have a ton of appetite, it seems like, for spending and budget-busting policies. Where are the bond vigilantes?
Well, the bond vigilantes are first and foremost most concerned about inflation. And we just really, it's the same question. Where's inflation? And inflation, I'll go out on a limb, but I've been on the limb for quite some time. Inflation's dead. And it's been killed by all sorts of things like aging demography around the world, and too much debt is actually not being stimulated, it's actually weighing on economies. And then technological disruption is a big issue. So central banks, I think, have managed to offset deflation rather than bring back inflation. And so the bond vigilantes have been pretty relaxed.